Now we're focusing on a high net worth individual looking to create an estate plan that efficiently transfers wealth to their heirs while minimizing tax liabilities. This scenario covers so many important aspects of long term financial health. Sam, Taylor, are you ready to dive in?
Absolutely, Alex. This is something I've been meaning to look into more seriously. It seems complicated, though.
It can be, Taylor, but breaking it down into manageable pieces makes it much less daunting.
Exactly. Let's start with the basics. What are the key considerations when developing an estate plan and choosing beneficiaries, Sam?
Well, the first step is identifying what assets you want to include in your estate. This could range from bank accounts and investments to property and personal belongings. Then you need to decide who your beneficiaries will be. These are the individuals or entities who will inherit your assets. You'll also need to consider what type of distribution you want: outright inheritance, a trust, or a combination. Tax implications are a huge consideration as well.
So, if I understand correctly, it's not just about writing a will. There are different ways to transfer wealth.
Precisely. A will is a core component, but there are other tools like trusts that offer greater control and potential tax advantages. For example, a revocable living trust allows you to manage your assets during your lifetime and then seamlessly transfer them to your beneficiaries after your passing, often avoiding probate.
That's a good point, Sam. Probate can be a lengthy and costly process, something many people want to avoid. Can you elaborate on how a financial advisor helps navigate these complex strategies?
Absolutely. A financial advisor can help coordinate with estate planning attorneys to structure your estate plan efficiently. They can analyze your current financial situation, project future needs, and help minimize potential estate taxes. For example, they can help you understand the implications of gifting assets during your lifetime versus transferring them through your will.
This reminds me of what we discussed about tax optimization in the previous segment for the 35-44 age group. It sounds like those principles carry over, but become even more critical with larger estates.
You're absolutely right, Taylor. The strategies become more sophisticated, but the underlying principles remain the same. Minimize tax liabilities and maximize the amount transferred to your beneficiaries.
Sam, could you give us a practical example of how a financial advisor might coordinate with legal professionals in estate planning?
Certainly. Let's say a client wants to establish a charitable remainder trust. The financial advisor would work with the attorney to structure the trust in a way that maximizes the tax benefits for the client while also fulfilling their philanthropic goals. The advisor can also model different scenarios to show the client the long-term financial impact of various estate planning strategies.
So, if I have significant assets, it's crucial to have both a financial advisor and an estate planning attorney working together.
Precisely. The attorney focuses on the legal documents and ensures everything is legally sound, while the financial advisor focuses on the financial implications and ensures the plan aligns with your overall financial goals.
So, to recap, estate planning isn't just about writing a will. It's a complex process involving asset identification, beneficiary selection, and choosing the right wealth transfer tools like trusts. Tax implications are a major factor, and a financial advisor plays a critical role in navigating these complexities and coordinating with legal professionals. If you're thinking about estate planning, and especially if you have significant assets, I highly recommend consulting with both a financial advisor and an estate planning attorney to create a plan that truly meets your needs and objectives.